Once again, very warm welcome to all of you. Today's session is very interesting one. But before we start this session, let me show you a picture. Remember this picture? Who can forget the famous headbutt and subsequent red card to Zidane? Right? So what happens when a player is shown red card and asked to sit out? Have you ever been part of a team which is playing with just 10 players? What are your chances of winning in such a case? So today we will discuss about how this red card impacts banks' performance as well as their valuation. It is divided into two parts. In the first, I will show you the result of my understanding and then explain it subsequently. So first thing first, you must be owning some banking shares or planning to buy some. There is always a question, is it rightly priced? While the universe is large, how can I find the right one to buy? So let me give you a ready reckoner which you can apply to find the two answers. This table is your ready reckoner. What you have to do is pick your stock, find out its latest value, book value, multiply it with 1 plus ROE twice because you have to look at for 1 year forward, not just the current year but 1 year forward, and then multiply it with the given value. You get the fair value estimate. Again, a simple way for a complex problem. So when I apply this to some of the banks, I find some shares offer good upside even from their current market price. Now you can check for your own stocks. Please note, this is not a recommendation to buy. You should always seek your advisor's guidance. Let me now move on to the explanation part. While this session deals a lot with banks' valuation, it is equally relevant for our banking friends who are in the branches, in the field. It would give them a bird's eye view on how their work contributes to bank's value. This perspective is very important. So if you like it, please share with your friends in banking. In any business, there is a risk. In banking, even after due credit and risk management, borrowers can go bust and result into bad loans. Hence, it is a genuine business risk which is priced into when loan is granted to the borrower. But when the size of bad loans crosses the threshold, the bank itself gets into the trouble. And today, we are discussing the same. For the last 10 to 15 years, this problem is even more challenging for three reasons. A. Banks, particularly the PSU ones, are constantly in need of capital to remain solvent in light of their large provisioning quarter after quarter. B. From a business problem, it is now turning into a moral hazard. And C. Instead of multiple regulations, resolution tribunals, and specially created institutions, it is insufficient to tackle this situation. And most importantly, all these are post facto. In this session, focus is not on macro part but at micro level, how NPA creates a problem for the bank and also for your own investment into a banking stock. And we will analyze it quantitatively. So I have kept the assets and liabilities very limited for easy understanding. So a bank has typically three sources of funds: shareholder capital, borrowings and deposits. Likewise, it has two uses of funds: loans and advances and investments. So to remain strong, the typical leverage is 1:8 to 1:10 in terms of shareholders capital and deposits. Likewise, 30 to 35% of liabilities are kept aside in the form of investments and the rest can be used for loans. So in our example, we have assumed a level of 5% of loan turning into bad loans in the second year, as there is some lead time before one can recognize an asset as bad loan. So let us move from balance sheet to P&L. So interest income on loans and investments, interest expense on deposit and borrowings, these two result into net interest income. Fee and other income, which is not taken here for ease of understanding. However, to offset the same, operating expenses I have kept at 35% instead of approximately 40% in real life. So after deducting operating expenses, what we get is operating profit. Since some of the loans have turned bad, as a prudent measure, banks have to provide for the same from their profit, something we called provisions. This provision is required to absorb the sudden impact on profitability in case the asset becomes irrecoverable and has to be fully written off subsequently. So this provision is built up quarter after quarter by way of charge into profit and loss account. So for the given balance sheet, which is by the way is a close replica of our banks, generating a profit of 20 rupees for every 100 rupees of capital of that is ROE of 20% is actually possible. And when a bank does that, even at a level of bad loans of 5%, it deserves to earn a fair value of almost 2 times its book value. I will not go into the details of how price to book value is calculated using ROE and the growth rate, but it is safer to understand here that if your bad loans are controlled, profit will be good, returns will be good, future growth looks good, cost of capital is low, and all this results into a premium over your book value, and that is what this is 2 times. So in this particular case, based on year 2 numbers, for every 100 rupees of shareholder money, the fair value of the bank is rupees 190, that is 1.9 times. Since we are dealing with this issue of NPA and its impact on valuation, the quick question comes in mind: what if the gross NPA is just say 1% or 10%? So let us look at how this multiple would look like. So let us look at the sensitivity of value under different scenario. For 5% of gross NPA and at 5% of cost of funds, particularly deposits, the value is 190. If the gross NPA is just 1%, this multiple is as high as 2.9 times. And at 10%, this is close to 0.9 times. So the penalty of having loans, bad loans, is very high. Also, if you notice, it is not so straightforward. We all know problem doesn't come from just one side. If the bank is facing bad loans problem, somewhere it starts impacting its ability to raise capital or deposit at competitive rates. So when my gross NPA moves from 5% to 9%, the value actually doesn't move horizontally, but towards the bottom right corner, and the value will be more likely at 0.5 times instead of 0.9 times, right? So now the bank shares start trading below their book value at a certain level. So let us look at the chart for value under various scenarios. Two things you will notice here. A, as you move to less gross NPAs, your value rises steeply as compared to when you improve but still not considered out of woods. And B, in real life, the bank will travel a path which will actually originate at 367, the top left, and end at 4, which is bottom right. For the simple reason, your cost of funds or yield on advances or say NIM will behave accordingly. In fact, 6% of gross NPA is a threshold for the bank to command a premium over its book value. Now let us distribute it in 4 quadrants. The top left is the most desirable one for any bank. Likewise, the bottom right is the most undesirable one. So you should check if any of your own investments is sitting in the bottom right quadrant, and unless you are convinced of improvements in their business fundamentals, I see no reason why one should hold the stock of such banks. For your convenience, I have plotted some key banks on this chart, and they sit beautifully on this. And let me tell you, they closely follow their valuation and market price too. I am sure you all can guess where most of our laggard banks lie on this plane. Let me reiterate here that all the numbers I have taken is of FY20. So when you are trying to figure out what is undervalued and overvalued, you should use the latest figure and plus 1 year forward numbers. Based on FY20 data for some key banks, you will find that a combination of low NPA and lower cost of funds results into healthy ROE. Actually, if you have low NPA, it frees up a lot of resources for other fruitful activities. Otherwise, the major effort goes into dousing the fire only. Let me deviate for a moment here and focus on the role of various deposit and loan mixes, which normally analysts look while analyzing a bank. And this is important from two perspectives. A, NIM improves, and two, diversification helps containing bad loans. So yes, it helps, and for a healthy bank, these are the areas of further improvements. But we all know for weaker banks, it's a less priority because what you are trying to save yourself is from the capital erosion itself. So let me now summarize this as how bad loans start a vicious cycle. It starts with a decline in size of your earning assets. So at 5% gross NPA, now only 95% of your assets are earning. So on one hand, you earn on less assets, but you have to provide more, which is an expense in P&L. When profit is low, your ROE is also going to be low. And we have seen in many cases ROE even lower than the cost of equity. We know ROE multiplied by retention determines growth. So when ROE is low, growth is automatically low. This then impacts your valuation. It is just safe here to assume that ROE directly impacts my price to book value multiple. When your multiple is low, cost to raise fresh capital is high. So now you are having double whammy, low ROE and high cost of equity. This seriously dents any economic value you are creating, and in some cases even destroying the economic value. Then it impacts your credit rating. Then it means cost of raising deposit or borrowing is also going to be costly. So your NIM will be adversely impacted. The worst come when regulator now starts putting restrictions. Even lenders from whom you borrow funds, they start putting their covenants much stricter. We have seen so many cases of RBI putting banks under restrictions and moratorium. Then it results into looming threat of corporate governance, which may include incentives mismatch, accounting frauds, even in worst cases like siphoning of funds. And lastly, it can easily call for bank run or forced acquisition or merger. So in all, it's a slippery downslide. So now we know how much it hurts when you are playing with just 10 players and not 11. At the end, I sincerely believe that this session would have helped you understanding the snowball effect of NPA on the bank's financial and its valuation. This will help you in not only finding the right banks but also at right price. I have tried to simplify this tricky issue and hope it was easy for you to understand. Next time again, I'll come with another interesting topic which directly impacts your portfolio and investments. Till that time, stay safe, stay healthy. Namaskar.